Okay, let's talk about what happened in January 2026. The Indian copper market, and I'm talking specifically about the MCX, just saw a surge of historic proportions. The volatility got so extreme that traders started calling it tachymeter speed, like a stopwatch needle spinning completely out of control. So today, we are going to dig right into the fundamental drivers behind this so-called red gold rally.
So take a look at this chart. This really lays out the anatomy of that January spike. You can see the price action just rocketing to a record high of 1,432.35 rupees. That sharp incline? It actually forced the CME, the Chicago Mercantile Exchange, to step in and hike margins by 20% just to try and curb speculation. But the real tension you can see here is between all that speculative heat and the hard reality of physical scarcity. And it's that physical floor that we really need to understand.
And that brings us to the central question, right? The one that's driving crows of investment. Are we just watching a temporary, speculative bubble that's all fueled by hot money? Or is this something more, a durable, structural repricing of copper that reflects a whole new reality for the global economy? Let's dig into the bull case.
Now, the bull case isn't built on just sentiment or hype, it's built on a hard physical floor. This rally is being held up by a severe, physically backed supply deficit that you simply cannot ignore.
This slide right here shows the global supply shocks that are driving this deficit. We're seeing some major disruptions at two absolutely critical sites, Cobre, Panama, and even more importantly, the massive Grasberg mine in Indonesia, which is partially offline until the second quarter. Now, to put that into perspective for you, just look at the LME inventory levels. Those are the global warehouse stocks. They are critically low, sitting at just 147,000 tons. There's just no buffer left.
And this is the number that really cuts through all the noise. A projected refined copper deficit of 330,000 tons for the fiscal year. Now, this isn't just some short-term forecast. This is a structural chasm between global demand and what we can actually produce right now. It really reinforces that core idea. You can't just print more physical copper. This deficit, that is the fundamental signal.
Okay, so let's flip over to the demand side. This isn't your traditional construction story anymore. This slide shows what some analysts are starting to call a structural AI tax on copper supply. The huge power and connectivity needs of AI data centers are projected to create 475,000 tons of new demand this year. This year alone. And at the same time, the energy transition is just accelerating, with every single EV, as you can see, needing almost 3 times the copper of a regular car.
So let's bring this all back home, to the domestic front here in India, because there's a pretty unique dynamic at play that's causing our local MCX prices to sort of decouple from the global LME benchmark over in London.
This chart is absolutely critical for any MCX trader. As the US dollar to Indian rupee exchange rate pushed up to a historic 92, the landed cost, and that's the final price including import duties and shipping, for every single kilogram of imported copper has just shot up. So what does this mean? It means even if the global LME prices correct a little bit, the weakness in the rupee creates a very firm, and you could say artificially high, price floor for all Indian buyers.
To put it simply, a weak rupee is basically acting as a shock absorber. It's defending that domestic price floor on the MCX, insulating it from minor global pullbacks, and just keeping that baseline price elevated.
Of course, no analysis is complete without putting on a skeptical lens. We have to look at the bear case and acknowledge that there are some significant macroeconomic headwinds out there that could absolutely challenge this supercycle thesis.
And here it is, the core conflict laid bare. On one side of the scale, you have that incredibly powerful structural deficit. But weighing against it are some very legitimate macro headwinds, the constant threat of trade wars, the risk that industries might start substituting copper with cheaper aluminum, and of course, the ongoing slowdown in China's property sector. Now, while these risks are definitely real, the consensus from the analysis we've seen is that the physical deficit is still the dominant overriding force in the market.
So, what's the verdict in all of this? Well, the evidence seems to be pointing not to a bubble, but to a fundamental structural shift in the copper market. Let's look at the strategic conclusion here.
For traders and analysts watching this space, these are the key pivot points you need to keep on your radar for the next 12 months. First, watch for any inventory divergence between those low LME stocks and what's happening in regional stockpiles. Second, keep a close eye on rupee volatility. Any moves around that critical 92 level are going to directly impact the landed cost. And finally, watch mine reliability and any announcements about the restart dates for Grasberg and Cobre Panama.
So what's the ultimate takeaway here? Well, the day-to-day lot-by-lot price swings, that's just noise. The deep structural supply deficit, that is the true signal. The diagnosis for Dr. Copper, as they call it, is a severe supply shock, and that is fundamentally reshaping this entire market for the foreseeable future.